We're talking about why your taxes are going up throughout your retirement, even if Congress doesn't raise them. Okay, now this might be a silly question, but why does this topic matter? Okay, well, oftentimes within some of our YouTube videos, especially on the Roth conversion front, there's a lot of confusion around Roth conversions. And does it make sense to even perform Roth conversions? Does it only make sense if taxes go up in the future? And there's all these misunderstandings. And what I want to show in this presentation today is that whether you take more income, whether you make any drastic changes, if you keep the same inflation adjusted income throughout your retirement, your taxes are going up. And so this has some incredible implications. I think if you're on the border of deciding if a Roth conversion makes sense, it probably makes sense to, this presentation alone probably makes sense to push you over that border and do that Roth conversion. But again, that's not advice. Everyone's situation is different. Big legal disclosure there. But again, as we go through this presentation, I think these concepts are really going to come alive. And we've talked about a few of these concepts together, or at least touched on them in past Wealth Wednesdays that we've done. We had a minimizing stealth taxes in retirement. A lot of those stealth taxes are going to come back into this presentation, but I'm really going to assign a dollar value and show you exactly how much your taxes are likely to go up. Again, even if Congress doesn't raise taxes. And then also a common adage is common adage is most people thinking taxes will be lower in retirement. And again, as we move through retirement, your taxes will go up. I'm trying to prove this in a very apparent way in this presentation today. Okay. So what's the basis for taxes going up? Okay. Why are taxes going to naturally go up even if Congress doesn't raise taxes? Well, basically there's two forces here. There's inflation meaning that essentially the dollar is devaluing. And there's a lot of reasons for this. We won't get into the economic reasons why, but essentially you're having to take income raises throughout retirement in order for you to have the same purchasing power as you did last year, as you did the year before that. You need income raises. Now those will adjust. Inflation varies throughout. It's varied throughout the last 20 years. It's going to vary through the next 20 years. But there are a lot of stealth taxes that don't adjust to inflation or adjust more slowly to inflation. So basically, if you're taking income raises and the tax rates aren't adjusting at the same to the same extent, more of your income each and every year is becoming taxable. It might be pushing you into higher brackets. Okay. Again, we'll kind of show more specifics as we go through this presentation. But let's talk about inflation here for a second. Now, I'm going to kind of split this up into two regimes here. And you can kind of make out these regimes. This isn't a scientific split or anything like that. But as you can see, we have two fairly drastic regimes. So through this whole period, going back even before this graph was started at the beginning of 1900, beginning of the last century, inflation's ran about 3.75% across that 121-year time period. Okay, but as of recently, we've been slightly spoiled. Inflation's been pretty low. Okay, inflation over the last 20 years, again, just drawing a non-scientific line right here, has averaged somewhere around 2.5% in that range. But we can see well before that, we saw inflation that was, again, not drawing a scientific line here, probably closer to around 5%. So we've essentially had two different inflation regimes here. And there are a lot of different reasons for that. The big thing is no one can really predict where inflation is going past a couple of months and whatnot. So how will inflation play out through your retirement? Again, that's yet to be determined. There's a lot of things that will feed into that discussion. We've seen inflation over the past year running over 5%. We've got four reports in a row looking at 12-month inflation where we've seen inflation higher than 5%. So will that continue? Again, it's definitely a concern in our planning practice right now. Higher inflation continuing, but again, no one knows. There are certain people that think inflation is going to go back down. The important thing being that regardless of this situation, we see that inflation has been high, and we need to be planning for different inflation regimes throughout your retirement. It's also important to note as well, though, that a lot of people, when they're building a retirement plan or they're having an advisor build a retirement plan, they simply take their first year's income goal and they just apply inflation to that. Okay, so let's say you assume inflation is going to be 2.5% I see a lot of advisors basically taking, let's say someone starting out needs $80,000 of income. So what they'll do is they'll just grow that by 2.5% throughout retirement. One thing I would push for many people to do is, as in the same way we're varying returns, we're varying investment returns through a Monte Carlo, I would also recommend you do the same with inflation. The other thing that's very important is splitting out certain expense categories that you have. So we see on the screen here a bunch of different categories. CPI here is right here. It's kind of a lighter orange line. And notice there's a lot of things. CPI, by the way, is just kind of the typical measure for inflation. There's a lot of things that our inflation has taken a larger toll on over the last, well, this is a little bit over 20 years here. A big one and a big expense category, especially for retirees, as they grow older and get later into retirement, are these up here. Okay, medical care services, hospital services. Okay, these are categories where we've seen in hospital service category, basically double inflation, triple inflation in some instances. So what I would urge everyone to do is take your income goal and split it out into certain categories. Usually we split it out into 2 categories at the very least. The base income need, that'll be things like travel, housing, food and beverages. Notice this has been slightly above, above normal CPI going into the past, but pretty close. But then split out your healthcare costs separately and apply a larger inflation rate to those healthcare costs, especially out of pocket. Okay, and what you'll see is that it plays out slightly differently in the plan. A plan that looked really good when you're spending $80,000 for and just looking at 2.5% inflation for 30 years. If you split out $10,000 of that and increase it at a more of a medical inflation rate, you'll see it definitely takes a toll on the plan. Okay, so again, this is something I would urge everyone to do. I think it's the most accurate way to incorporate inflation into your plan. And what difference does this make? It just so happens I have the example here of 80,000. So let's say someone is taking $80,000 of income and they're adjusting for 2.5% inflation, and they're just assuming all of the income that they need is adjusted for this 2.5% inflation. What will they need at various points throughout their retirement? We're looking at a 30-year time period here. Obviously, year 1, they need $80,000. Okay, year 10, however, because all of these raises they'll need in between, their income needing to increase by 2.5% each and every year, they're going to need $102,000. By year 20, it's $131,000. By year 30, it's over double what they initially started out needing. So again, this kind of reinforces that we need income raises throughout our retirement just to keep spending the things we spent at the beginning of retirement. Okay. So what happens though if we try to be a little bit more accurate and we break out separate inflation categories? What changes? Okay, keep this in your mind right now. 80,000 to 102 to 131 to 167. Okay, well, let's say we take $10,000 of that budget and we apply, that's basically our medical expense budget, and we apply a higher inflation rate. Okay, what happens? Okay, we're going to double that inflation rate for healthcare needs. And all of a sudden, 80,000 by year 10, we need 3,000 more. We need 105,000, right? I think, yep, over $3,000 more. Okay, by year 20, we need 141,000. Before we needed 131,000. So we need $10,000 more. By year 30, we really see the gap grow. 190,000 that we would need, again, to keep up with the same spending that we did in year 1 versus 167. So again, hopefully this illustrates the need to break out these separate categories of inflation to make sure your retirement plan is as accurate as possible. Your income goal is basically the tail that wags the retirement dog, if you will. It will drive everything from tax planning to if your probability of success is sufficient enough, and everything in between. So your income goal needs to be as accurate as possible. Okay. Well, as we can see, because of inflation, especially breaking these out into separate categories, we're needing some significant income raises throughout retirement. Well, the problem with why taxes are going to go up in the future is because of stealth taxes. Congress has done a great job, and hats off as far as sliding these rules underneath the average Americans, right underneath their nose. But rather than taking tax raises through time and making it very apparent, for instance, taking the 10% bracket and raising that to 15%, there would be an uproar if something like that happened. They've included finer details as part of the tax code that will cause your income to rise faster than tax brackets adjust. One of these was a part of the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act was a big opportunity, especially for Roth conversions. We're going to touch on that a little bit as part of this presentation, but it's certainly not going to be all of it. Part of the Tax Cuts and Jobs Act, we know the standard deduction went up, tax brackets went down across the board about 2 to 4%. The smaller thing, the small change that was part of the Tax Cuts and Jobs Act that slid underneath many people's nose is how they changed how tax brackets are now adjusted to inflation. They changed from CPIU to something called chained CPIU. Okay, basically what that does over time, and we see a chart here from St. Louis Federal Reserve, we see that there's been a big gap grown. So basically what this means, this gap over here is what, if we would have been under, and we have been for the most of this period, under the under normal CPI adjustments, here's where brackets would have adjusted to, or I should say, here's where inflation, here's where CPIU would have, here's what the inflation rate, I guess, has been for the last a little over 20 years. Chained CPIU, you'll notice there's a few changes in that chained CPIU that will make it adjust slower. Basically, the big change is that they assume that you will, given high inflation in one category, you will substitute. So rather, if chicken has some significant inflation, you'll substitute that with turkey. And I think they make some kind of leaps. That's a fairly simple example. They make some leaps with the chained CPIU. Big reason being they can adjust, again, the tax brackets at a slower rate. If we look at through this whole period, the total adjustment here is basically it's going to adjust about 0.25% slower, or historically it has, than regular CPIU. Okay, so basically if you're assuming 2.5% inflation for normal CPI, what I would recommend you do as you adjust tax brackets is adjust them slower, adjust them at something like 2.25%. And this seems like a very small change, but we'll see it play out in a big way over time. Ron's got some questions on alternative minimum tax. Yeah, I'll try to talk about that kind of towards the end as well. Great point to bring up. So what difference will this make? On the screen here, I took off some of the higher brackets, but basically what I have are tax brackets adjusted over time. Okay, so I'm basically showing on the dotted line, I'm showing what going forward into the future of the next 30 years, if we just assume 2.5% inflation and adjust tax brackets slightly slower. In the dotted line, I'm showing what tax brackets should adjust to. Okay, in the solid line, I'm showing what they will likely adjust to with the new chained CPI. I think I have this wrong up here. Both of them are CPI. One of them's chained CPIU, the other is just CPIU. So a little error there in the subtitle. Nonetheless, though, we can see there are some big gaps that are grown throughout here. And the y-axis is a little skewed, so these brackets down here won't look like a big difference. But again, let's look at this top bracket here. Whoops. This top bracket here, we're looking at, this almost probably a $40,000 to $50,000 difference in adjustment by the end of this 30-year time period. So this will make a big difference over time. Let's fill in some income. Okay, let's adjust under normal and healthcare inflation rates. And what you'll see over time again, and this is looking at this very simplistically, just assuming the same income need through time, you'll see that this person starts and they're in the, what is this? Looks like they're in the, what would that be? The 12% bracket. And notice over time, because of some different planning things, the Tax Cuts and Jobs Act here, and then just the slower adjustment to inflation over time, we see that they're going to go from the almost bumping into the 22% bracket to having a fair amount of income in the 22% bracket over time. Now, this further is exaggerated when we talk about RMDs. And if you're not dealing with an RMD situation, so we know in a lot of cases, taxable income isn't a static thing, or the income need you have isn't a static thing, because RMDs force you to take more income than you need. And so this creates a situation where, let's just say RMDs start here in let's just say year 8, just randomly picking this out. If you're seeing higher income through this period because of RMDs in a situation that you're not dealing with, again, we're seeing because of your tax rate rising over time because of these different inflation targets, you're seeing this become even a bigger problem through time. Okay, and it's not only federal taxes. We're going to wrap this all together too. If some of this is confusing, I'm going to try to put this in layman's terms towards the end and talk exactly on how big of a difference it makes. It's not only federal income taxes, but we also have to think about state taxes, depending on the state that you live in. Now, we live in the great state, the cheesehead state in Wisconsin, which has some fairly high income bracket tax rates relative to the rest of the country. Okay, we're here in the orange. Again, this is judged. The darker red it gets, the worse tax brackets are. The closer to yellow gets, the better tax brackets are. In gray, there are no state income taxes. Okay, and again, not only federal taxes have this indexation problem to inflation. Okay, some states adjust to inflation pretty good. Here in the dark blue, you'll see those states. Some only partially adjust to inflation. So once again, we're seeing an issue where you're having to take more income to keep up with inflation, but tax rates, tax brackets aren't adjusting as quickly. It's pushing more of your income into higher brackets over time. The other thing as well, and I can't speak to every state, but our home state's standard deduction, Wisconsin's standard deduction, goes down as you have a higher taxable income. So on the x-axis here, we have income. On the y-axis, we have standard deduction. What you'll notice is the more income that you take, the lower your standard deduction will be. So again, this is a situation where you're getting double hit. Wisconsin's brackets aren't adjusting as quickly to inflation, and inflation's making you take more and more income. So basically, if you started, let's just pick some random target here. If you started at 60,000, well, inflation adjusted, you're going to be pushed this way over time. Thus, your standard deduction is going to go down, gradually decrease each and every year, because again, they're not indexing to inflation as well. Wisconsin has a gradually decreasing standard deduction. So you'll get hit twice essentially. So we have to include federal taxes as well as state taxes. Okay. But it's not only the brackets that are the problem here. There are also certain tax hurdles specific to retirees that also don't adjust to inflation. Okay. Let's talk about one tax hurdle that isn't really a stealth tax, but it's going to cause taxes to go up. We've talked about this a lot. I won't spend a lot of time on this. Tax Cuts and Jobs Act put into law in 2018, set to sunset in 2026. Basically, what the Tax Cuts and Jobs Act did is it raised the standard deduction for a married couple by about $10,000, and it lowered each tax bracket by about 2 to 3%. So the tax bracket that used to be the 15% is now the 12. The old 25% bracket is now the 22. The old 28 is now the 24. Well, in 2026, we're set to revert back to the old system. And so what you'll see in a lot of the charts, a lot of the tax planning charts, it can be, we have a lot of questions, I guess, around these type of jumps right here. Why the heck do we see tax brackets all of a sudden go significantly lower here? And again, this is because of the Tax Cuts and Jobs Act expiring. So basically, tax rates are going to go up. Less of your income will be underneath a standard deduction. So you will see taxes rise in 2026. Unless Congress extends out this Tax Cuts and Jobs Act, there's not a whole lot of talk around that, especially with this current administration. You know how politics play out. If one administration from one side put into a tax law, it's very unlikely that the next administration from the other side is going to continue with that. So it's very likely we see the Tax Cuts and Jobs Act expire in 2026. I think the better case, I shouldn't say the better case, the more likely case is it even ends before that. Okay. Again, summarizing, Tax Cuts and Jobs Act will cause taxes to go up. The bigger thing, especially for retirees, is around Social Security's taxability. So in 1983, they started making Social Security taxable. Okay, and this is a line from 1983 from some of those amendments that were passed. Basically said if taxpayers combined income, total of adjusted gross income plus interest on a tax exempt income plus 50% of Social Security benefit, For an individual, if it's over 25,000, and for a married couple, if it's over 32,000, up to 50% of your benefit may become taxable. Well, they've only added to this taxability. They haven't taken away. And the more important thing is keep in mind this $25,000 and $32,000 chart or limit, I should say. Keep this in mind because here's where the current provisional income targets are. Provisional income hasn't changed. They still take your adjusted gross income, tax exempt income, things like muni bond interest, and they added 50% of your Social Security benefit. But notice the 50% target here is still at 25,000 and 32,000. Okay, it was in 1983. It currently still sits there. So when they put this into law in 1983, there weren't a lot of people that were pushed above these threshold amounts. Because if we basically take out inflation, what did a car cost in 1983? Okay, what did normal things at the grocery store cost in 1983? Far less than they do today because of inflation. And so these targets haven't changed. And so what's slowly happened over time, more and more retirees' Social Security benefits are becoming more taxable. This will continue to play out over time. There hasn't been any talk around indexing these for inflation. It hasn't happened in the last, what would that be, 40 years? It's probably not going to continue to happen. So what's going to happen? You're forced to take more and more from your retirement assets. Why? Because of inflation. So your adjusted gross income is going to go up. Your Social Security benefit is adjusted for inflation. So that's going to continue to go up. And so your provisional income is going to keep rising higher and higher. That means more of your Social Security benefit is going to become more taxable. And so again, if you start retirement with a certain level of Social Security taxability, that is going to continue to rise as well, thus raising your taxable income. So we have all of these forces that are playing into taxes going higher and higher. Okay, we know Social Security, again, is an inflation adjusted asset. These are the last 30 years of inflation adjustments. We expect a pretty big one going into 2022 as well. That should be announced here in October. But we've seen Social Security benefits, again, adjust to inflation. We think this is going to continue to happen. There hasn't been any talk about not adjusting to inflation. And so this is a situation, again, where your Social Security benefit is going to keep rising higher and higher. That's going to push your provisional income higher. So in layman's terms, the higher your provisional income will go, the more you're going to owe in taxes, the more of your income that's going to be taxed. Well, let's take an example. Looking at provisional income, looking at these two targets here, and what you'll see, again, not surprisingly, is when we look at this in the context of inflation, your provisional income is going to rise. Again, is going to rise through your retirement. Again, in layman's terms, this is going to cause your taxes to rise. Okay, and we see it rise pretty steadily. Notice what's not changing, this 85% and this 50% taxability limit. Okay, because Social Security's taxability is not adjusted for inflation. What's going to happen too with the Social Security tax torpedo? So again, for those that don't know, if this is your first time watching, if you're on our YouTube channel, and this is your first time watching a Safeguard Wealth Management YouTube video, we talk about this a lot in a lot of our presentations. Okay, basically the Social Security tax torpedo is created because as you take more from your retirement assets, the way Social Security is taxed, it will cause more of your Social Security benefit to be taxed. So essentially you're double taxed. $1,000 withdrawal from your retirement assets, you're taxed on the $1,000 withdrawal. You're also taxed on the amount that $1,000 withdrawal moves into Social Security taxability. So again, it creates these zones where this intuitively is where most people think they're taxed at. There's a red line here. The blue line is where you're actually taxed at. Those are your actual marginal rates. And what you'll see through time, and this is created by adding capital gains, and we won't get into that too deep. Focus on these numbers right here. Basically, what's going to happen is you see your tax rate rise 50 to 85%. Again, this Social Security tax torpedo chart is going to look different for everybody based on how much you have coming from Social Security. But again, because of these stealth taxes, what's going to happen is if you start retirement and you fall right here on the Social Security tax torpedo, what's going to happen over time is you are going to be pushed this way because you're taking more from your assets. It's causing tax rates aren't adjusting as quickly. and provisional income is continuing to rise. So more of your Social Security benefit is then moving into taxes. It's going to push you further into this zone. So there's going to be a little bit of what's called a bracket creep, where your income is going to slowly float into worse marginal rates. Okay, the other thing too, we're not going to focus a ton on, but something that's worth noting as part of the Affordable Care Act, to help pay for that, they basically subjected really every American to this Obamacare 3.8% surtax. It's otherwise known as the net investment income tax. Basically, when we talk about long-term capital gains, if your income is higher than $250,000 for married filing jointly and $200,000 for a single filer, you'll have an extra 3.8% added surtax on long-term capital gains. So the 15% bracket turns into 18.8. The 20% bracket turns into 23.8%. Now, we're not really going to include this in the following graphs, but again, this is not adjusting for inflation. You can see this right on the IRS's website. Taxpayers should be aware that these threshold amounts are not indexed for inflation. This is right from the IRS's website. So there's all these things in the tax code that are hidden that aren't adjusted for inflation. Most Americans aren't going to realize this. They're not really going to realize this slow march into higher brackets either. But it's important as we plan at the beginning of your retirement to plan for this slow hike. Okay. So what is the effect? Let's kind of wrap it all together, kind of show some more real world results. So what I have here is I'm using a person scenario, somebody with 55,000 of IRA withdrawals and 45,000 in Social Security income. Okay, I'm using combined inflation, so I'm using both normal CPI and then I'm adjusting a portion of their income need for healthcare expenses. Okay, I'm including state income tax. I am including Wisconsin here. That's our home state. It's going to adjust, obviously, if you're from a different state. If you're watching this on YouTube, again, these pink bars might adjust a little bit. They might be higher depending on what state. They might not be any if you're in a state that doesn't have any state income tax. Okay. So what we see here, when they start out in retirement, okay, they're owing just under $10,000 in total taxes. Okay, and this dotted line here is basically if the tax system was perfectly set up and was as fair as most of us think it should be. Okay, these bars should basically follow this black line here. So this is basically taking the first year's this first year's tax liability and just adjusting it for inflation, adjusting for whatever inflation we're using in this example. We're using 2.5% for an income need. If tax brackets adjust perfectly, we would see basically your tax liability adjust in accordance to this black line here. But what you'll see, because of all of these stealth taxes adding in, okay, you'll see there's a huge gap the longer that we live. This gap has been going on for a couple of years now, depending on which stealth taxes you're looking at. It will play out through the entirety of your retirement unless other things are changed. And so you'll see this jump here. Again, we can see we go from just over 10,000 to just over 15,000. So about a $5,000 jump because of the Tax Cuts and Jobs Act we see right here. But looking at everything else played out, notice by the time we get to the end of our retirement, okay, our taxes should have stayed, if they were perfectly inflation adjusted, they should have stayed at just under $20,000. Okay, let's call it 18,000. And look what actually happened to the taxes this person would have owed. Again, assuming that they're continuing to take the same income need, just adjusted for inflation through time. Okay, their taxes are just under 40,000. Okay, so this person is having to take more than double what's expected for their tax, their inflation, or sorry, their tax, more than double what it should have been if it was perfectly adjusted tax or to inflation. Sorry. And so this is fairly eye-opening. Again, if a Roth conversion is right on the border, if you're kind of perfectly assuming taxes are going to adjust to inflation, and a Roth conversion that you're calculating out is right on the border right now, again, these type of graphs probably push it over the edge that the Roth conversion makes a lot more sense. Your taxes will rise over time. We could see this in a big way here. Okay, these gaps really start to add up. Okay, do you think taking $18,000, $20,000 more from your retirement savings towards the end of your retirement is going to make a difference? It sure is. Okay, let's look at the differences in a dollar amount. Okay, so again, this is the basically the added tax from stealth taxes. So we're using the baseline as this black line here. Well, the baseline is this black line here. And then what I'm showing is basically the difference in taxes. And what you'll see, Tax Cuts and Jobs Act really skyrockets it. But then we see from here through the end of your retirement, taxes on a dollar basis rise pretty greatly. Okay, 10,000, let's just say for sure $5,000 to $20,000 extra in taxes than you might be currently assuming. Okay, on a percentage basis, again, we see the same thing play out. 50 to 100% more in taxes, again, than you might be assuming if you're calculating out future taxes in the wrong way. If you're assuming everything normally adjusts to inflation, that's not how things are currently set up. So you're assuming that Congress makes some big changes to basically adjust taxes in a way that benefits the average American. I don't think that's going to happen. If anything, we're going to be adding more stealth taxes because a lot of people haven't seen these stealth taxes. They won't see it play out into their retirement. But again, if you're trying to make the best tax decisions in retirement, you should be considering this slow march into higher and higher brackets. Okay, so this was a little bit shorter of a presentation than I usually do. We included a lot of graphs here. Hopefully it was informational though. Ron's got a question about the widow's tax trap upon death caused by RMDs. Yes, I mean, this will definitely play out as well. For those that don't know, and I'm going to go up here just to be able to navigate faster. For those that don't know, this is basically assuming, this is on a married filing jointly, but this would be assuming both people are passing away at the same time. Okay, what the widow trap is essentially if one spouse passes away, you go from the married filing jointly to the single filers bracket. So what you'll see over here is, let's say in 2045, one spouse passes away. You'll see these drop significantly. Again, because they're going to the married filing jointly and going to the single filers bracket. So again, if we included this, I didn't really include this in the analysis. I should have, Ron, after you mentioned this. But again, you'll see this play out again, where taxes will rise even higher when you factor in the death of one spouse. And so again, in summary, I know I went through some kind of more, I won't say more advanced, but surely some more obscure parts of the tax code. The big kind of summary message is that taxes are going to rise over time. In these examples, we see somebody needing pretty basic amount of $55,000 from IRAs, $45,000 from Social Security. That's not out of the question as far as it's not crazy high income amounts. It's pretty average for an average middle class person. Again, what is that? $100,000 of retirement income, upper middle class maybe, depending on your situation. But we see taxes over time are going to rise 50 to 100% higher than they were at the start of your retirement because of these stealth taxes. So again, this is extremely important as you're building a forward-looking tax plan, as you're implementing tax strategies today. Because of the Tax Cuts and Jobs Act, because of these stealth taxes playing out over time, we are in some significantly lower brackets here. Okay, we should be using these to our advantage. Okay, so in summary, the importance of building a forward-looking tax plan can't be overemphasized here. Taxes are going up, even if Congress doesn't raise taxes. Now, if we did a presentation last night. Okay, I had about 40 retirees in a room. We were talking about Social Security. I took a poll of the room, asked them to put their hands up. Who thinks taxes are going to rise in the future? Who thinks Congress is going to raise taxes? Every hand shot up. Okay, so many of us already think taxes are going to go up, but even if Congress doesn't raise taxes, we see taxes are going to go up because of all these stealth taxes. So hopefully this was informational. Always remember, you don't need more money. You need a better plan. You need a forward-looking tax plan that prepares your retirement for the future. Again, if you have any questions, let me know. If I missed any, let me know. And thanks for watching. We'll see you next week on next week's Wednesday. Thanks, everyone.